After weeks worth of disheartening economic news, which certainly took its toll on the market at large, we are back on the mend, which just goes to show all of us as investors that we should never really listen to all of the noise that's out there, but rather just focus on the companies that are going to see through the thick and the thin, the market ups and the downs. Most importantly, above all, reward us all with returns. So today I have 6 dividend stock opportunities that I think will do just that I want your eyes on this upcoming week, but that's all after I cover some of our need to know macros. Now also, today's video is sponsored by Visual Sectors. Major shout out to them. More on that to come. Investors, are you ready? Now, I don't need to harp on it, but we've had quite a month, which is just to say we've spent all of April and now the earlier days here in May in the red from our economic news that really didn't sit too well with us investors. Starting with the latest inflationary report that was hotter than expected, right down to the Federal Reserve's latest release of their FOMC meeting minutes, which keyed us all in to interest rate cut projections, which I'm just going to come right out and say it right here, right now. I am doubtful that rate cuts will actually occur this year. Now, quote me on that, and should I actually be wrong, go ahead and blast me in the comments. Either way, when we think about living in this higher interest rate environment while inflation is still baking, the reality is businesses and consumers will be pressed monetarily, thus making us all more restricted. Now that immediately then means that we should begin to look into companies that are directly dealing in B2C business, because chances are that's exactly where we're going to find some really ripe opportunities to invest into and ultimately hold on to for the longer haul. However, this past week, we actually got a bit of a giddy up in the market from a jobs report, which depicted that we added 175,000 jobs to the US economy, which was actually much less than expected. And the market reacted favorably to that news, which is now exactly where and why I want to dig in for just a moment. You see, the Federal Reserve wants to slow the economy down to tame inflation. So that very report rallied the market because what it really showed all of us was that the economy is in fact slowing down, meaning we're doing good in terms of the Federal Reserve, and that will ultimately lead to interest rate cuts. So if I had to just come full circle here with you, I want you to remain with your eyes and ears on the Federal Reserve, focused on their words for when they actually reduce rates. And until then, go after all the golden opportunities that are out there that are presenting themselves right now. Speaking of a lot of these golden opportunities, let's go ahead and cover the 6 of them I have for you now. First up, I want to go ahead and get to a dividend gem that I haven't really mentioned recently. We have good old Johnson & Johnson, ticker symbol J&J, which is actually hovering around its 52-week low mark as a big pharma and medtech whale. Now, it belongs in any dividend investor's portfolio, but it makes today's list because it's facing talc litigation while also dealing with medtech margins that are declining, as this economic backdrop is just calling for overall budget tightening for hospitals and medical facilities. But now, on the other hand, Johnson & Johnson just delivers through on revenue growth as of their latest earnings report, while also continuing to cook up a solid product pipeline, which means as J&J trades for $148 per share, it is worth your attention right now in my book. And after 3 years worth of the good fight with this economic environment, I'm bullish on Johnson & Johnson for the post-interest rate cuts to come our way, as after all, we've seen over 93% worth of share price appreciation over the course of time here. Moreover, when it comes to J&J, I can just say that with total confidence, this is an investment that usually sways between the lows of where we're seeing it right now today and then the about $170 to $180 range, which is on the money with analyst forecasts coming in at $174.62 per share. It's about 17% worth of upside. And until then, it's all about the dividend, with the yield coming in at 3.33%. Now that's 22% above its 5-year average, which is also just amazing to see 108 years worth of a track record, while also growing here by 8% year over year. Next up, I want to go ahead and talk about one stock opportunity that keeps sliding after every single consumer trend report comes out. We have Darden Restaurants, that's ticker symbol DRI, which is a restaurant operator of some of America's most popular restaurant chains. Talking about the Olive Garden, to Longhorn Steakhouse, and their fancier Capitol Grill. Now, as consumers really begin to cut back on spending and dining out, sure, Darden and all the similar companies out there to Darden are going to take a hit, but by no means should that actually dissuade you in investing into these businesses, as long as their balance sheets and business models remain healthy in this economic context. So I continue to like Darden, coming in at $147 per share, which is down by almost 9% on the year, but zoom out with me to see over 336% worth of share price appreciation over the last decade, while analysts are forecasting over 21% worth of growth, with this stock rebounding about $180 per share. And until then, you're also going to enjoy a very savory dividend here, coming in at 3.54%, not quite as stable as the other players today, but growing nonetheless by about 23% year over year. Now, coming up to dividend stock number 3, I want to go ahead and talk about Tyson Foods, ticker symbol TSN. Now, some of you are going to balk about this one, but if it gives you any comfort at all, this is an investment not into a restaurant operation, whereas the business could be a little bit shakier, but rather into one of the world's largest beef, chicken, and pork processors that's feeding all of you at these restaurants. Now, you have to note that Tyson took a massive hit as animal feed prices spiked, and not only that, but consumers actually remain very budget conscious and strict right now, especially with the meats that they're buying from the grocery store, meaning Tyson is just struggling. But we can see that after 3 years of struggle, whereas the stock is currently down by about 18%, clicking over to year to date, we are back on the mend, already up by over 11%, still trading for under $60 per share as we speak. Now, this is purely an investment into a company that is going to need an economic turnaround to actually come our way to then flip back into rebound mode. But I think these hedge funds are right on the money here as they begin to actually take advantage of these low share prices. We can see smart money pouring millions into Tyson as of last quarter. But here's where our money dance should begin. When it comes to the dividend, we have a yield coming in at 3.31%, still strong after 32 years worth of a dividend history, and an average dividend growth rate here of about 13% year over year. Now, investors, we were officially at the halfway point, meaning we have 3 more dividend stocks coming on up. But I briefly want to talk about your next move, or what should be your next move right now, and that's subscribing to the channel for all the market insights and stock ideas that I think you're going to need to reap massive success on your financial freedom journey. But also, right now, I want to ask you to tap on that thumbs up button just to let me know that you're not only enjoying this content, but getting value from it, so I can keep creating more content like this. And last but not least, would you like to know what other traders are actually planning or what they're executing on? Well, if I told you that there was a way to see all the open trades with their exact target and time frames, would you believe me? Now, this is exactly where today's sponsor comes in, Visual Sectors. Whereas they're providing you with a comprehensive map of open positions of other traders, so you can easily understand the entire market sentiment, see expected targets for stocks and ETFs, and just better time your trades while factoring in support and resistance levels. Now, it's as easy as going over to their site, visualsectors.com, typing in a ticker symbol to immediately see the green and red bars worth of open interest aligned monthly, weekly, or even quarterly. Now, their approach has been developed by a team of quants from firms like BlackRock and the alike. So we are talking about industry vets that have literally been crushing it on the street. And moreover, Visual Sectors has reported about an 82% win rate in their public predictions. I take last week, just for an example, they predicted that Tesla would take off after their earnings call there from about $160 of an entry point to a $200 exit, paid off in less than 5 sessions. So if you want in, sign up for a free trial now or enjoy a 40% discount code using my name. That link is going to be in the description as well as the pinned comment. Now let's kick right back to it with Starbucks, ticker symbol SBUX, which we could just take a moment right now, right here, to mourn for a likely departure of their CEO if he can't pull this coffee house behemoth out of the muck of all this red. Starbucks recently fell to $73 per share, which is down by over 22% this year. Now that's just very disappointing and shocking. They're not so shocking based on their earnings. But folks, Starbucks is a luxury brand, and those consumer trends that are shifting as we speak are just not good for business. And knowing that management is everything, I don't think a menu change or application updates will really work all too well. I think it's going to be about getting back to basics and tailoring prices to consumer trends and their wallets. Now, Howard Schultz, who has been on the sidelines, has even been speaking out rather recently because, after all, this is his baby, which makes me question if he would actually come back to work. But I also just want to show you through their history, because this is certainly not the first time where Starbucks lost significant ground only to make it all right back up to ultimately soar by nearly 150%. Now, as for analysts right now, they are actually bullish here, predicting over 40% worth of upside, coming up to $103.15 per share. But until then, you're going to enjoy a nice dividend yield coming in at 3.1%. It's been on a dividend track record here for 13 years while growing roughly by 17% year over year. But if Starbucks has you up in arms, it's a little bit too risky for you. I totally get it, and I want to bring it back home to a level of comfort for you with Home Depot, ticker symbol HD, a home improvement retail leader that has been declining based on our economic conditions. Whereas we see the stock trading for just $338 per share, that's down from almost $400 not too long ago, and zooming out about 452% worth of share price appreciation history, all while analysts are still bullishly projecting a nice comeback here to $397.17 per share. It's about 17% worth of upside. And of course, until then, a nice dividend coming in at 2.66%. That has been steadily growing here for the last 36 years now by a whopping 19% year over year. Next up, my go-to investment. I'm talking about one that I want to scale to 100 shares. Visa, ticker symbol V, which is in the business of transaction facilitation and often misunderstood as a credit lender. But no, this gem is all about that little tiny fee that's charged to the merchants every time you and I swipe our credit cards. Meaning, we see that Visa's business is only continuing to boom, though it's currently trading for $277 per share. That's down from almost $300 per share back in March. But check this out. Zoom out with me to see over 460% worth of share price appreciation. And I would only suspect that over the course of time, Visa is going to remain a top dog when it comes to transaction facilitation, even if cryptos get introduced into the picture on a much bigger scale. Now, a sign that I really like to see from the company itself is a share buyback program. So take a look here. We saw just the other month that Visa purchased nearly $3 billion worth of stock back, while analysts right now are favoring the company as well, forecasting a share price to hit $316.40 per share. That's over 14% worth of upside, and until then, a smaller chunk of a dividend here at a yield of 0.75%, which means plenty of room for growth even after 15 years of a dividend streak with a growth rate of roughly 18% year over year. Now, investors, let me know your thoughts on these dividend stocks. If you're buying or if you have better ones in mind, drop all those comments down below. Don't be afraid to also let me know your thoughts on visual sectors. Be honest. I take no offense to any of the comments that you leave behind, but also just be sure you're subscribed to join this journey, and I'll make this one easy for you. Catch more insights by just clicking right here, right now.